London, are you there? London? Anybody in London hear me? Okay, thank you, Boston. How about New York?
New York, good morning.
Morning, New York. How about Philly? Nice work, Philly. Philly there?
Philly's here.
Okay, good morning. Memphis, Miami. Good morning. How about Houston and Dallas? Good morning. LA and San Francisco?
Houston.
Good morning, LA. Good morning, San Francisco. We're going to start out with Todd Bergman. Todd, can you hear me?
Yeah,
Bill.
Okay.
What?
Bill, there's a conference call going on still.
Conference call. We're not supposed to wait for any conference call. I'm sorry. I wasn't given any word about the conference call.
Hey, Bill.
Yeah, I'm afraid we're going to have to go ahead. You know, we're in the crunch period, and no one said anything to us, and I think we've already earned this out, I thought, about 100 times. Todd, go ahead. And then Robert Morris. Robert, can you hear me? Robert Morris in London.
You want to go?
Yeah, go ahead, Todd.
Thanks, Bill. Good morning. This is Todd Bergen. Actually, I'm out of the office, and I had a chance to attend a meeting yesterday in Madrid that was held by Repsol to discuss the natural gas business and also their exploration production activities. And we have a lot of comments on the screen, and I will just make a few.
That solid landing is going to be managed a lot differently in the future than it was in the past, and that should have some increment to the overall value, should enhance the growth rates and the cash flows for the company, and therefore we should look at it in that context and assign some higher valuations to that. What we've done is we've looked at specifically other companies around the world which, one, are dealing with competition just as the local telephone industry is dealing with competition.
Thanks. This is Anthony Carpet on Birmingham Steel. Just as an update, Birmingham Steel reported first quarter earnings yesterday after the close of 17 cents per share versus 31 cents per share. That was exactly in line with our recently reduced expectations. We are maintaining our fiscal or June 1994 estimate of $1.25 per share and our fiscal 1995 estimate of $2.40 per share. We continue to recommend the shares as they sell at only about 13 times our earnings estimate for the next 12 months, which is $1.80 per share. Again, as we were speaking yesterday, the reason why earnings were short of what we were originally expecting was slightly higher than expected scrap prices, as well as some additional startup costs at the company's Seattle mill. As far as the longer-term outlook, we continue to believe that the company will earn $1.25 this year, $2.40 next year. Between fiscal 93 and 95, and it should be noted that in fiscal 93 they reported 68 cents. The company should benefit from $1.70 of earnings improvements. Earnings should come from several different places. First, increased prices, $1.05 per share, decreased conversion costs, and by conversion costs I mean the cost to convert steel scrap into finished steel product. That'll have a 40 cents impact, a higher margin mix, a 30-cent impact, increased volumes, a 70-cent impact, and lastly, it should benefit from the consolidation of American Steel and Wire, a company which they're acquiring. That should help by 25 cents. However, again, earnings will be negatively impacted by higher scrap costs, which should have $1 impact per share. So despite reporting disappointing results, Birmingham continues to be both on our recommended and priority list for three reasons. They are: first, again, the shares sell at only 13 times our next 12 months earnings estimate of $1.80. Second, the company is a low-cost producer with non-union labor. And third, the company should exhibit earnings momentum. This quarter should be the next quarter should be the first time in 4 quarters that will report a year-over-year earnings gain. Furthermore, we continue to believe that the stock has more than 50% upside potential during the next 18 months. We believe the shares will trade at a market multiple based on fiscal 1995 earnings once the company begins to demonstrate earnings momentum. Any questions?
This is John Campbell. The September-October private client focus that will be distributed this week contains the following changes. First, as we stated in August when the Investment Policy Committee increased its equity exposure. We've raised our equity exposure by 10 percentage points to 55% and reduced our fixed income and cash allocation by 5 percentage points each to 35% and 5% respectively. The current recommended allocation of investment assets is equities 55%, fixed income 35%, cash 5%, and inflation hedge 5%. Second, we've removed General Mills from the selected recommended equities portfolio because as a policy decision, we do so when the stock is withdrawn from the U.S. recommended for purchase list. We now rate General Mills shares as a moderate outperformer. Bill and I have also added Masco to the consumer durable sector, and in the Japanese package, we have added Aoyama Trading and Murata Manufacturing. Aoyama Trading has been blue skied in 8 states, and Murata Manufacturing has received blue sky clearance in 37 states.